Andrew Milligan, you are head of global strategy at Standard Life Investment. Mr. Milligan, since the Brexit vote in Great Britain at the end of June, the British FTSE 100 index has gone up more than 5%. Are you surprised by the positive reaction from the market?
I'm not surprised by the reaction because, of course, we've seen a very major reaction from the central bank and the promise, of course, of more action from the UK government. So clearly, Brexit does cause risks for the UK economy, an uncertainty shock, the worries about future investment plans will cause the UK economy to slow. But we have seen a very solid response from the Bank of England, not just a cut in interest rates and not just extra quantitative easing, but also new support for banks in the UK and the promise that more will come. And we've also seen already a new government that's been formed within 10 days, incredibly quickly, and the promise that the old fiscal plans will be changed and the promise of some new infrastructure spending coming along. Now, we still wait the details of that, but by and large investors have been pleased. And the other thing we have to remember, of course, is sterling did fall 10%. So that means that a lot of the profits for UK companies translated back into sterling are now better. So I think the market's bolstered, supported by the actions of the central bank, supported by the promise of more action from the UK government. Whether that happens is what will cause the next direction for the market.
So there wasn't a big shock, but could it possibly happen when the Brexit actually happens, or what do you think?
Well, we really do emphasise that Brexit is not an event. Brexit is a process, and Brexit will last years. And I've been asked how long, and it might be even up to 10 years that it lasts. But we have to remember that it's 2 years for the Article 50, and then we've got all the trade negotiations between the UK and the European Union, and what the trade negotiations are between the UK and other countries. And it is extremely uncertain at present, not just what the UK will ask for, but what the rest of the European Union will agree to. So we really see it as a process lasting years, and in between time there's going to be very, very detailed negotiations, and there will be the occasional crisis and spat and argument which will attract market attention, and then we'll go back to very boring, tortuous legal discussions again. It's just a very long process.
So if you look at the markets right now, what are the big drivers? Is it mainly the central banks and their actions, or is there something else that's driving the market?
Well, I think there's three. The first is central banks, the second is politics, and the third is earnings. Central banks have obviously reduced interest rates. I mean, 40% of government bonds around the world are now in negative yielding territory. And they're flattening yield curves, they're buying assets. I mean, they're buying equities and exchange-traded funds and property and government bonds and corporate bonds. So central banks are buying a lot, and obviously that's affecting markets. The second is politics. We've already discussed Brexit, but we have the Italian referendum approaching and the US elections approaching, and then more elections next year. And all of these potentially could be big market movers and could encourage investors to run for safety. And the third is corporate earnings, because at the end of the day, what we're investing in is companies' cash flow and dividends and their promise that they'll repay that corporate bonds that we bought. And there has been a recession, there has been weakness in corporate profits for 12, 18 months now. Now, the good news is that may be starting to come to an end, and into 2017 there may be some better profits growth ahead. And I think that would reassure many investors. So we've got to look at central bank actions, we've got to look at politics, and we've got to look at the earnings cycle. Those will determine where markets go in the next year or two.
Speaking about your investments, do you avoid countries with negative interest rates, like, for example, Switzerland?
I think by and large we have to be extremely careful about buying bonds with a negative yield unless you are absolutely certain that you just want your money back. But in terms of investments, I think there's a lot of other fixed income assets that one can think about in other parts of the world. So Switzerland, Japan, much of Europe with negative yields. But there are many countries with positive bond yields, the US, the UK, Australia. There are many corporate bonds that are worth buying, emerging market debt that's worth buying. So I think investors can find income from fixed income assets in many other parts of the world, and really have to be quite cautious about buying any bond that's negative yielding in any country, unless it's a very short-term decision indeed.
So if you look at investing opportunities right now, maybe besides the fixed income part, what options are there for investors?
Well, we've talked a little about the normal fixed income assets such as corporate bonds. We're certainly looking more at emerging market debt, so sovereign debt or corporate debt issued in the emerging markets. Now, again, this is partly simply because of the yield advantage, but it's also the realization that with recessions ending in countries like Brazil and Russia, with China still continuing to grow, that the economic backdrop for these countries is reasonable. It's not great, but it's reasonable. The other asset that we're really encouraging investors to look at is real estate, commercial property. Now, obviously in the UK, that's been affected by the UK's referendum outcome. But we still around the world are seeing, especially in Europe, but also parts of Asia and parts of America, there's many real estate prospects, commercial property prospects that are quite good. The world economy is growing, and by and large, because banks are not lending that much, we're not seeing so much speculative build, new build, as we perhaps did in previous cycles. So the supply-demand balance for real estate looks quite good at present for many parts of the world, and Europe is certainly one of those.
So what do you expect from the European market in the second half of the year?
Well, I don't make forecasts for the second half of the year. That's not the way that we look at markets. We're long-term investors, and we're normally trying to look several years out. By and large, I think we should warn that European equity markets face a difficult time ahead of them, as do equity markets all over the world, because economic growth is not particularly strong. Central banks are doing what they can to support it. We haven't yet seen the evidence of company profits picking up. In Europe, we do have the worries about the Italian referendum and what the outcome will be. And then we've already started the campaign, of course, for the French presidential election. So there's quite a few political events. By and large, we'd expect European equities to be range trading. Now, our longer term returns are, this is a world of low numbers. We're suggesting that European equities might grow about 5% a year over the medium term, simply because this is an environment where it's very difficult for companies to raise prices. Dividend yields are all right, they're manageable, but they're not going to grow that much. So we really warn investors that if you are a long-term investor, you're not going to be getting returns much more than 5% unless you take on a lot more risk. So unless you're trading more, unless you're buying alternative assets, unless you're giving money to a very niche equity fund manager, perhaps small cap or infrastructure or whatever it is. But by and large, this is a slow growth world. And if it's a world of slow growth, your equity returns are going to be rather lower than they were in the past.
Mr. Milligan, thank you very much.
Thank you very much indeed.